William Green, author of Richer, Wiser, Happier. Hello and welcome to Talking Trading.
Hi, delighted to be here with you.
Oh, William, it is wonderful to have you here. You have written for many leading publications in the USA and Europe, including Time, Fortune, Forbes, Barron's, The Economist. You've reported from all over the world, interviewing presidents, prime ministers, investors, and countless billionaires. And you've recently written a bestseller called Richer, Wiser, Happier, which is a pantheon of super investors. Over 25 years, you spent hundreds of hours interviewing investment legends face to face. People like the likes of Warren Buffett's billionaire partner, Charlie Munger, Vanguard's founder, Jack Bogle, Sir John Templeton, and many more, full of quotes from the likes of Marcus Aurelius, Aristotle, Tolstoy, Shakespeare. Richer, Wiser, Happier is an exploration of how to think like the masters of investing. William, I loved your book. I loved it more than Market Wizards.
Thank you so much. I really appreciate it.
My pleasure. Let's cut to the chase. That's a very, very impressive resume from a journalist to a journalist. That's a very impressive resume.
Thanks. Yeah, you make me sound like I've been extremely busy and productive. So I appreciate it, because it's not really true. A lot of the times I was kind of twiddling my thumbs thinking, what am I supposed to be doing? How am I supposed to be productive? I would read those productivity books and take notes and then forget to apply any of what I've learned. So I'm glad if in retrospect it sounds impressive.
Okay. How did you become obsessed with learning about the world's best investors, William?
Yeah, in a totally unexpected way, because I'm embarrassed to admit I literally never took an economics class at school. I never took a business class, didn't go to business school. The idea of actually understanding, the idea of understanding accounting or anything like that, I can just about count to 9, maybe if I'm lucky. But what happened to me is when I was in my mid-20s, my brother and I had owned an apartment in London. And this is before property in London became unbelievably valuable. And we sold the apartment so that he could buy an apartment that did become unbelievably valuable. And so I had my share of it, and I had to think, well, so what the hell am I going to do with this money? And so I started to read about the stock market. And much to my surprise, having always been kind of dismissive about business, I thought business and the stock market were kind of vulgar, and that really what you wanted to do was write about literature and books and great ideas and philosophy. And then much to my surprise, I discovered this is kind of thrilling. And I think part of what I really loved about it was the fact that it was this idea that you could make money without actually really getting your hands too dirty. That I was kind of lazy and subversive, and I gambled on horses when I was at high school. I went to Eton, and when you were supposed to be, rowing or playing cricket or stuff on these lazy summer afternoons, I would sneak out and gamble on horses. And so I really was always obsessed with this idea of making money without working too hard. And then when I started losing money on the horses, I thought, well, this sucks. This is not a game I'm really enjoying. And I went cold turkey, and I didn't bet again. And I never bet at casinos or anything. But when I discovered the stock market, I thought, well, this actually is it. This is what I was looking for all along. But I had this tremendous opportunity, because not only could I actually invest and read about investing, but I could actually go and interview these people that I was reading about, because I was writing for magazines like Forbes and Money and Fortune and later Time and Barron's and the like. So I would do things like I would go off to the Bahamas and I would spend a day with Sir John Templeton, or I would interview Jack Bogle, or I'd interview Peter Lynch or Michael Price, who was on the cover of Fortune. Andy Serwer wrote about him and Fortune and called him the biggest SOB on Wall Street. And I would get to go interview this guy, talking to him about what he'd learned from his mentor, or I know all of these extraordinary people. I went to interview Fayez Sarafin, this guy an Egyptian billionaire known as the Sphinx. And I would go off to Houston, and he'd have this I think it was a 5th century mosaic floor that he'd bought from a Syrian church and had imported to Houston. And he had an El Greco and this unbelievable artworks. And so I started to write about these guys, and I just thought, these are incredible characters. And because most writers like me thought that money and business and investing were kind of crass and vulgar, it was like this field was wide open. If you were a storyteller, you could actually go write about these people. And there were so few people you were competing with who actually could see that it was really interesting. And so there were people like Brian Burrow and Michael Lewis, who were amazing writers about business and investing, but not that many. And so in a sense, that's what I've been doing on and off for the last 25 years is studying the stock market because I find it fascinating for myself, because I want to make money and become independent and secure. And at the same time, getting to go off and actually interview these remarkable people. And so what I was doing with this book was I was looking back and I was saying, okay, so what have I actually learned? Like after all of these years, what does it all add up to? What are the most important themes? How can you learn to become independently wealthy? How can you learn to become financially secure? But the more I thought about it, the more I realized, well, actually, these people are unbelievable thinkers. So it's not just that you're learning how to invest, you're actually learning how to think. And then I kind of had this counterintuitive conclusion that I was worried nobody would agree with, which is, it also occurred to me, they're really interesting models for how to live wisely, not because they all are the happiest, most contented people, but because they're incredible pragmatists. And so they think really deeply about questions like, how do I structure my time? What does my money actually give me? What actually makes for a successful and abundant life? And so the greatest investors became this kind of tremendous filter for me through which I see the world. So as a result, you have this very idiosyncratic book that's part guide to getting rich, part guide to dealing with things like resilience and failure and setbacks and stress, and part guide to how to think better.
It's slightly terrifying interviewing some of these billionaires.
Yeah, it's curious. I'm sure you found this as a journalist yourself. I would often get incredibly nervous before I interviewed someone. I would prepare absolutely obsessively. I'd spend days and days and days preparing. And then what I find again and again is, as I actually go into an interview, there's this sense of deep calm and joyfulness that descends over me, where you feel just this sense of total presence. And I mean, I guess it's probably very similar to what athletes feel when they're in a state of flow, where suddenly it's game time, and you're just with someone really interesting. Like, can you imagine? If I think about, say, my interview with Charlie Munger, I turned up an hour early because I didn't have very much time with him. So I thought, well, let's see, maybe I'll just show up an hour early and we'll see what happens. And so I'm just waiting outside this room for an hour. And eventually I'm shown in, and it's really crowded. There are a whole bunch of people who are talking, and it's noisy. And he's like this 90, I guess then 93, now 96, 97. This 93-year-old legend, with his hair sort of scraped over and his thick glasses because he can barely see. And I'm literally sitting like this far from him. Our knees are almost touching. And this is it. I prepared for weeks. And this is the moment where you have to be totally sharp and, totally observant. And when an answer doesn't go in the direction you want it, you've got to kind of pivot. And there's something just that's so deeply engaging and joyful for me about that. And I just love that. It's almost when I'm at my happiest. And so then all of the fear and anxiety that preceded it suddenly disappears. And then afterwards, you're done, and there's this kind of excitement, and then you're like, oh God, I hope my tape recorder worked, and you always have about 23 tape recorders, and you download your recording, and then you send it to yourself in about 14 different ways to make sure you've got it, and so there's a lot of anxiety around it, but the actual process of interviewing someone famous like that is very thrilling and deeply engaging. And then what I sometimes find, in that case, this was a very short interview. As I write about in the book, I literally traveled 3,000 miles for a 10-minute interview with Charlie Munger. And so I really had to make it count.
I hope you got paid well for that interview.
I paid for it out of my own pocket. But for other interviews, I would literally be interviewing the person for 2, 3, 4 days. There's
Mm.
the first chapter of the book is based largely on a 5-day trip that I took across India with Monish Pabrai. And
Amazing.
so I was literally sharing a bunk bed on an
Mm.
all-night train with Monish Pabrai. And so that's kind of the opposite extreme. And so there you're getting deeply into someone's life and you're seeing how they behave. And that's really interesting. That's really fun. I mean, there was a wonderful moment where we were in a train station. I think it was in Kota, somewhere like that in India. And Monish has this wonderful luxuriant mustache. And there was a guy who comes to help us with our luggage, and he's sort of carrying Monish's enormous suitcase on, or mine as well, on his head, I guess. And he's got an even better mustache than Monish's. And Monish had just had a terrible blow up of a stock. So he just had this terrible period. And so I said to him, he's not only got a better mustache than you, but I bet his returns have been better than yours over the last year. And so, and you're sort of watching, so how's this guy going to respond to the fact that I'm taking the piss about his returns and his mustache? And so that's the opposite extreme from an interview like that with Munger, where you're getting really deeply immersed in someone's life over days. And then there was an extraordinary interview that I did with a guy called Arnold Berg, who's a wonderful character who I end the book with, who after a couple of days with him in Texas, he hypnotized me. Oh. And so my meeting with him ended with me lying on the floor of his office in Austin, Texas, with him playing the Vivaldi's Four Seasons and hypnotizing me, because he very, very rightly saw that there are all sorts of problems in my subconscious mind that needed to be corrected. So he helped to rewire me. So my approach to reporting this book is pretty immersive. I'm trying to take you up close to these people and show you, no, we're inside their minds and inside their lives.
And you really do. And that was the privilege of reading the book. I can see that self-effacing British humor, affability takes you a long way. And I'm sure these people really like hanging out with you.
Well, also one of the things is you can ask impertinent questions if you ask it. If you ask with a sense of humor in an English accent. So you can actually ask really rude stuff. Well, and then I realized when I was writing about John Templeton and I looked back on my notes from 20 years ago, I had this transcript, I realized there's literally a moment where we were talking about his spiritual life. And I said, so do people sometimes regard you as a kook? And I'm looking back, I was probably 30 at the time. And I'm wondering, was I asking him this question that rudely because I was kind of provoking him in a fearless way? Yeah. Or was I just obtuse and I didn't realize how rude it was? And I suspect it was subversive, but it did get a rise out of him in an interesting way. So yeah, you do stuff differently when you're younger, I guess.
What are the common characteristics of these super legend investors?
Well, I think one of the most striking characteristics is that they're extraordinarily pragmatic. And so they don't really care about sticking dogmatically to their views. All they really care about is, does it work? So there's a wonderful line from Charlie Munger who says, I observe what works and doesn't work and why. And so he's just looking at all of these different disciplines, all of these different academic fields, and he's grabbing ideas from them that are helpful. So for example, he looks at mathematics, and there was this famous 19th century mathematician called Carl Gustav Jacobi. When I say it's famous, I'd never heard of him, but apparently he's famous. But Munger picked up on this famous quote from Jacobi, who said, invert, always invert. And so what Munger says is, okay, so you take this idea of inversion and you say, if, for example, I want to be a great investor, let me start by saying, what would it take to be a terrible investor? And so you invert the question of how to be a great investor and you say, okay, so let me list all of the things that terrible investors do. And then let me not do that. And so it's this really interesting way of solving a problem backwards. So you solve the problem forwards as well, because you say, how can I be a great investor? But it's a more thorough way of thinking. And so that's a very typical thing that a great investor is doing. They're saying, okay, there's this mental model that I can grab from math and I can apply it to investing. Or a lot of the great investors meditate. And I don't think it's necessarily because they're thinking, oh, I'm going to become enlightened, although that is the case in with a couple of very successful investors I know. They're really serious about their meditation. I think it's more because they're thinking, how do I become calm? How do I make my mind like a calm pond so I can think better, so that I'm not torpedoed by my emotions? So they've seen that meditation is extraordinarily powerful in giving you emotional equanimity. So they're like, yeah, I'll grab that. I'll grab a little bit of mindfulness, because that'll improve what I do. So I think that pragmatism is extremely helpful. They'll look at the science of habit formation, and they'll think really seriously about how to take ideas from habit formation experts and apply those. So I write at some length about Tom Gaynor, for example, who's the co-CEO of Markel. So here's a guy who's in charge of maybe $20 billion or so in stocks and bonds, and maybe 20 fully owned companies and about 17,000 employees. And he's reading constantly. And so part of his study of habits has led him to think, well, so I don't really need to be optimal. What I need to be is directionally correct. So he takes all of these habits and he says, so let me just have a set of habits that are directionally correct. So for example, at one point, he said, I weigh more than 200 pounds at this point, and I used to weigh, I think he weighed something like 194 pounds when he started. It was something, maybe a little less than that. And so he said, I'm going to lose 1 pound a year for the next 10 years. Because he said, it's basically an understanding of compounding. So most middle-aged men like me are putting on 1 to 2 pounds a year in middle age. And if you can lose 1 or 2 pounds a year, it's this tremendous benefit of marginal incremental improvement. And so that's a beautiful example of something where you're understanding that compounding is one of the great forces in life. I mean, it's evolution, right? And so if you harness compounding, these small marginal improvements actually turn out to be incredibly powerful. And so I love this idea that the greatest investors become this kind of filter for everything that works. And they're perfectly happy to abandon an idea if it doesn't work. So Munger will say, any year where you don't destroy one of your most best loved ideas is a wasted year. So he's actually looking for what he calls disconfirming evidence. So if you think, most of us, when you read the newspaper, right? I mean, here I am in New York, and we've just come through, this very fraught political era. Where all of us disagree really intensely. And so if you're liberal, you read things like the New York Times op-ed page. If you're a conservative Republican, you read the Wall Street Journal op-ed page. Munger very consciously goes and reads the views of the smartest people who disagree with him. And so he's consciously trying to dismantle his own cherished ideas. And so that's an idea that really he took in part from Darwin, because he said, look, Darwin was this very pious, very religious guy, and he writes about evolution, and he's basically dismantling his own most cherished beliefs. And to have that kind of intellectual honesty, to do that, it's an extraordinary thing. So that to me is a beautiful example of the way that the greatest investors think better than most of us. They're not saying, let me just cling to my own prejudice because that's how I feel. They're saying, no, let me test this. And let me try to destroy my own opinion. And so if you have this idea of trying to stress test everything that you think, it's an incredible advantage for an investor, right? So I remember talking to a friend of mine, Ken Schubenstein, who's a very successful investor who taught the advanced investment research class at Columbia Business School for a decade. And I sat in on his class, and he would talk about doing pre-mortems. So if you think about a post-mortem in a medical setting where you look at, well, here's why this patient died. He's saying, picture the investment you just made and imagine in 3 years that it's just died and that you lost all your money. And now write an account of what killed it, why you were wrong. So you're forcing your mind actually to study what could go wrong. So it's a really beautiful technique to take something from the medical world, and Ken is in fact a doctor as well. He's a neurologist and an expert on the brain. So he's taking an idea from medicine and using it to force himself to think about what could go wrong with an investment. So they're much more rational thinkers than most of us. And it occurred to me eventually, I was trying to think why it was that this was the case. And it occurred to me eventually, it's because they have skin in the game. And so if you're a journalist and you screw up, it's embarrassing, right? You maybe someone catches you and you have to admit that you made a terrible mistake, and you're kind of sheepish and you have to admit it to your editor. It's a horrible thing. I had it once about 20 years ago where I got a date wrong in an article that I wrote about John Templeton, and it was because he got the date wrong. And I still felt incredibly foolish. You know, it was about his own life. But he got the fact wrong, and he got the date wrong, and someone wrote in and complained. So it's really embarrassing, right? I'm still smarting from it 22 years later. But I didn't really pay a price. But if you're an investor and you're managing $10 billion, $20 billion, $1 billion, and you screw up, there's a real price to pay. And yes, there are people I've interviewed who literally manage money for 2 million people, and they're managing their life savings. They're managing their kids' education savings. They're managing their retirement money. So there's skin in the game. And I think that forces you to concentrate and try to avoid catastrophe in a way that journalists, politicians, economists, TV pundits, we're also lazy in our views. We'll take any view if it sounds provocative, and we don't really pay a price if we're wrong.
Which of the investors are seeking enlightenment and do hardcore meditation?
That's an interesting question. Well, I've had 2 really interesting meals in the last few weeks with excellent hedge fund managers, where I've ended up talking almost exclusively about meditation and spirituality. And there's a friend of mine, a guy called Josh Tarasoff, who I invested with a couple of years ago. He's a very good hedge fund manager, and he was one of these 2 people, and he takes his meditation really seriously. And it's funny because what happened is I sorry to be so self-referential, but I was investing in a hedge fund for a long time that then I got kicked out of because they changed their structure. And so I was no longer able to invest in it. And so I asked my friend Guy Spear, who's also a very successful hedge fund manager who I've invested with for many years. I'm like, I don't want to give you more money because, you know, you've got a big chunk of my life savings. Who else should I be looking at? And he said, go meet Josh Tarasoff. Josh is really smart. And I met Josh in New York. And one of the things that struck me is he's very calm. He has this really, I mean, it was funny. I was asking him about his parents. And he said, yeah, my mom, she's really chill. And it's I haven't really heard that word in a long time, but it's a great word to describe Josh as well. He's very chill. And I think it comes in good, I mean, partly it's temperamental, but partly it's because he really meditates seriously. And that was actually one of the reasons why I invested with him. I mean, I know he's really smart and he manages a concentrated, long only, very long-term portfolio, which is kind of a style I happen to like. It fits my prejudices and temperament. But the fact that he's so calm is hugely appealing, because if you think about the stress that we go through as investors, a huge part of the game is actually both controlling your own emotions and exploiting other people's emotions. And so when you were asking me before what links a lot of the greatest investors, one of the most obvious things that links all of them is the lack of emotion. And so it helps if you do something like meditation, because it lowers that emotional reactivity. But then I would also say, when you look at great investors like Charlie Munger, Howard Marks, Ed Thorpe, Bill Miller, a lot of these people I interviewed and profiled in the book, they're very unemotional. I remember interviewing, I was writing a profile of Bill Miller, who I've interviewed many times, right after 9/11, and we were traveling together around September 23rd, 24th, right after, a few days after the Twin Towers were blown up, and the market was just in free fall. I mean, it had closed for several days and then reopened and was in free fall. And Bill Miller was just buying like crazy and was totally calm. I remember talking to a colleague of his, Lisa Rapuano, who was then an analyst at his firm and then ended up becoming a hedge fund manager in her own right. And Lisa said to me at the time that on 9/11, she said we were all kind of weepy and very emotional. And she said Bill was just like analyze, assess. And he had actually been in military intelligence. And so he was just very, very calm. And I kind of regard him as almost like a probability machine. He's just sitting there very quietly calculating probabilities. And Howard Marks is very much the same. When you're with Howard Marks, you have this sense, here's a guy who's just a most superior machine. You just know that he's got an extra 30, 40 IQ points, but also just there's this tremendous rationality and kind of icy calm. And I remember asking him after the financial crisis, where he and his partner, Bruce Karsh, had bet something like $500 to $600 million a week for 15 weeks running in toxic companies that were imploding, buying all of these busted bonds. They ended up making $8 or $9 billion in profits. And I said to him, did you find it hard to do that in the midst of the crisis when the world seemed to be coming to an end? He said, no, I don't remember it being hard. And I said, were you always unemotional? And he said, yeah. And I knew that he'd been married twice. So I said, has it been a problem in your relationships? And he's like, oh yeah. In my first marriage, it was really hard. He said, I've got a lot better since then. And so I think these people tend to be very unemotional. But for most of us, if we don't have that wiring, which I don't, I mean, I'm relatively fearful and anxious and get carried away with my emotions. And then get overexcited when everything's falling apart. I'll be like, this is fantastic. I knew it was going to fall apart all along. And then I start to become kind of bullish and I buy, and then it keeps going down more. So we all have our own flavor of emotional craziness. And so I think having habits that make you have more equanimity, whether it's meditation, exercise, prayer, walking in the woods, whatever it might be, it's important to understand that needs to be a part of your approach to investing, I think, unless you happen to have this unbelievable wiring, which most of us don't.
So, William, these titans in the market, what do they say about recovering from things like September 11, from unexpected failures? Sorry, there's noise out the front there. I can't help that. Unexpected failures, defeats, painful mistakes that we all inevitably make, and that 20 years later, you're still not getting over them and you still think about them. How do they get over them? What do they say?
Well, one of the most important insights came, I think, from Howard Marks, who says that first of all, you want to prepare for them. So you actually need to understand that the world is an extremely uncertain place. And this is not a bug in the system, it's a feature that everything is uncertain. And I remember talking to him right after COVID, when we were all in lockdown here in the US, and he was in lockdown himself with his family. And he said, look, when you talk to economists in late 2019 about the risks to the economy, not a single person mentioned COVID. We had no idea. We knew that a pandemic could come one day, but this was not on anybody's radar. And he said it highlights for you the fact that we live in an extremely uncertain world and that you need to respect uncertainty. And so I think that's really key, is before the event happens that crushes you, you need to prepare for it. So you don't, there's a lovely line from, I think it was Nietzsche, who said, if you stare at the abyss too long, you become the abyss. And so you don't want to be staring so much into the future and being like, oh my God, everything's falling apart, that you curl up in fetal position in the corner of your room and just groan quietly and never go out of your house. But you also have to respect uncertainty and know, yeah, things can go wrong. And I need to prepare myself, position myself to survive in an uncertain world. So what does that mean? It means you can't overreach. You don't want to be betting borrowed money. You don't want to be living beyond your means. You don't want very high recurring costs that you won't be able to get out of. I'm always thinking of this. I was thinking yesterday, I'm thinking of redoing our kitchen. And I'm like, this is exactly the sort of thing. This is like bull market complacency, where you're like, well, my portfolio's up, I feel good, I feel like the future's great. And I'm like, I'm always wary of costs that can come back and haunt you. And I think partly that's because I come from a kind of Jewish refugee family that kind of, we escaped from Poland and Russia and Ukraine,
Really?
in the first part of the 20th century. And so I think deeply wired in my DNA is this kind of fearfulness and need to survive. And so I just need to understand that there's that peculiarity in my wiring because it influences the way I invest. And so, but I think that's not a bad instinct, that kind of survival instinct of like, yeah, things are good, but let me not overreach, because if I overreach, I can get in trouble. And I think it's very telling that Ben Graham, who was Buffett's teacher, comes from a very similar background. And Ben Graham's family came from Poland. I think his grandfather was the chief rabbi in Warsaw at one point.
Oh my God.
And so Ben Graham's name actually was Benjamin Grossbaum, and he grew up in London and he had a wealthy father. And then his father, who was a successful businessman, died. And suddenly this family that had lots of money and this very comfortable existence went from being wealthy to being in real trouble. And his mother ran a boarding house that I think went bust, and she got caught. And I think there was a crash of something like 1907 or 1912, something like that. And she lost a ton of money. I mean, so they got really hit. And so he was absolutely ashamed of the fact that the family had to sell all of its furniture and all of the things that they had. It was a public auction. He was ashamed of that. And so if you think of the margin of safety, which is the idea that Ben Graham bequeathed to Buffett, which Buffett regards as the single most important principle in investing, it's basically that you want to buy things at a discount. You buy assets at a discount because that protects you against the uncertainty of the world and against your own mistakes. And so the safety, I would say, comes from the fact that Graham had personally and viscerally experienced so much uncertainty. He'd seen it with his parents, he'd seen it with his father's death, he'd seen it with his mother losing all this money. Then he did really well as an investor, managed to navigate the crash of 29, and then got killed over the next couple of years when he lost a fortune. So he went through tremendous pain as an investor. And so he had this huge focus on how you survive uncertainty. And I remember interviewing Irving Kahn, who had been a teaching assistant to Ben Graham, was very close to Ben Graham. And Irving Kahn died at the age of 109. And I interviewed him a few months before he died, when he was still 108, a mere young buck at 108. And,
sprightly lad.
And yeah, exactly. And I said to him, what's the most important secret of investing? And he said, safety, capital preservation. And he said, the first thing you always want to be thinking about is how much can I lose? And so with any investment, you're always asking yourself, what can I lose? And so this is a really important thing. Before you get hit by the swings and the swings and arrows of misfortune, all of the things that can happen, you want to prepare. You want to recognize the fact that we live in an uncertain world where things like COVID can happen. And I think that's really critical. And that's it. It's a very interesting nuance, because as Howard Marks said to me, if you become so obsessed with risk avoidance, you actually doom yourself to return avoidance, because you don't want to become so paralyzed by the sense that the world is a risky place that you don't bet. So what we're talking about is not avoiding risk. It's actually about taking intelligent risk. And I think that's what's so striking about the greatest investors, is they're very obsessed with the avoidance of catastrophe, right? They understand that you have to stay in the game, right? So the critical thing is just to stay in the game so you get to play another hand. So you can't get knocked out by taking ridiculous bets where you're over leveraged and you suddenly have to sell everything at the worst possible moment. But you also need to be aggressive when opportunity presents itself. And so I love this image from Charlie Munger, where he says that the best investors basically are like spear fishermen. And so he says you want to be standing by the side of the stream, waiting for a fat, juicy, succulent salmon to swim by. When one swims by, you spear it. And then you go back to doing nothing for the next 6 months because maybe there's no other salmon comes along. And I think you see this with the greatest investors is it's these long periods of boredom and inactivity punctuated with very aggressive action when the salmon swims by. And so it requires a certain type of mutant personality to be that able to sit on your hands and do nothing and then act so boldly. And it's funny that my book got translated into Portuguese recently, and there's a bit where I say in the English version that that Buffett would say that one of the biggest problems for an investor is that the crowd is always saying, swing you bum, and I say that Buffett, one of his great advantages is that he can sit there for years on end just twiddling his thumbs. And in the Portuguese edition, someone wrote to me and said, do you realize how they've translated this? And it turns out they're translated as Buffett could basically sit for years scratching his balls. And this apparently was the idiom in Portuguese. And so,
but it means the same, doesn't it?
Exactly. So that has now been changed and will not be in future editions. But yeah, so Buffett could spend years just twiddling his thumbs, and that's an extraordinary thing. And so if you think about most areas of life, we're told that we need to be dynamic and active and hustle. And here's this one area of life where actually, as Buffett says, you're not paid for activity, you're paid for being right. And so you need this kind of icy rationality where you can sit around and say, nope, not doing that, not doing that, not doing that, not doing that. And then after 6 months, 2 years, 3 years, you're like, yeah. And there's an extraordinary guy, Francis Chu, that I've written about before, who said to me, yeah, I could go 10 years without buying anything. And you're like, what would you do in the meantime? And he's like, oh, I just hit golf balls and I read 200 to 400 pages a day. And he called me recently and he took me through his portfolio, what he had done during that first month or two of COVID. And basically after years of tremendous inactivity, not being able to find anything to buy, he had just made an absolute killing in that one period. And it was kind of a perfect example of a spear fisherman at work, just waiting for an opportunity with very limited downside and massive upside. And that's the essence of the game, I think.
Can we talk about simplicity and simplicity being the ultimate sophistication, Joel Greenblatt's chapter? You say that Warren Buffett himself, have you met Buffett?
No, I've been to Omaha multiple times and I've seen Buffett speak. And one of the things that's interesting about Buffett is I've asked him several times for interviews over the years. And this is one of the things I write about is he's a master of saying no in a very charming way. And it's part of his advantage in life is that so in the same way that he's able to say no to investments, he's constantly saying no to these things that intrude on his life. And so he's able to just sort of sit there quietly with his blinds closed in his office, just reading annual reports with all of these kind of incursions coming in, trying to get him to do this and that and this and that. And so I don't know. I talked to Charlie Munger recently, and I said, yeah, Warren's still never given me an interview. Do you think he'll give me an interview? And Charlie sort of laughed and was like, I can only ask a certain number of favors from Warren. I'm not going to ask for that. And so I was like, oh shit, there we go. We'll have to try again. But you know, Warren is only 90 years old, so I still have time. Maybe 91.
So talk about simplicity being the ultimate sophistication. You say that Warren Buffett is the grandmaster himself of simplification. How important is simplification in investing?
I think it's hugely important in investing and in life. And really, it was Joel Greenblatt who made me understand this. And Greenblatt, for people who don't know, has one of the greatest records of any hedge fund manager. He famously made 40% a year for 20 years, which this astonishing feat means you turn $1 million into $836 million. So it's an incredible thing. And yet when I asked Joel, what's the secret? He said, well, it all comes down to this. He said, you value a business and you buy it for much less than it's worth. And he said, that's it. That's the essence of what he does. And so part of what happened with Joel is that he's taught for many years at Columbia Business School, which meant that he had to keep explaining what it was that he'd figured out. And he's also written these extraordinary books, which also forced him to distill what he believed. And so there was something about that process of distillation as a teacher and as a writer that made him gradually realize, that's what I do. And so he was able to distill the essence of the game to valuing a business and buying it for less than it's worth, which is essentially what Buffett and Ben Graham had talked about as well. It's what all of these guys are saying is that I mean, this goes back to Ben Graham, right? It's that the market is kind of bipolar, and so it has these mood swings, and so it's not pricing companies in a necessarily accurate way. Some, for the most part, maybe yes, like the market is pretty efficient, but particularly at extremes, suddenly people will become very greedy and they all love, Tesla, or suddenly they're all very fearful and they all hate Alibaba, and so as the spear fisherman, you're just kind of waiting for these moments where there are these tremendous mispricings, and then you take advantage of it. So what Joel Greenblatt said to me is, if you have this simple understanding that what you're trying to do is value a business and buy it for less than it's worth, he said it gives you this tremendous context to understand what's important and what isn't important. So he said, for example, if I own a supermarket company in the Midwest of America, and there's a Greek sovereign debt crisis, and the papers are just full of talk that this is going to trigger economic contagion throughout Europe. He's like, I don't give a damn. He's like, why does it matter to me? My supermarket in the Midwest is just fine. And so he said, what you realize when you start to understand that you can simplify the game to that extent is that most people are engaged really in fruitless nonsense. And so he said, you start to discover that 99% of what most people are thinking about in terms of the markets is actually, as he put it, silly. So if you think about the amount of time that people spend reading the latest news headlines or worrying about what inflation is going to do, they're not really focused on the key point, which is it cheap? Is this company cheap? And so there are different paths up the mountain. There are a lot of different ways to invest. But for someone like Joel Greenblatt, that simple understanding, is it cheap, becomes incredibly helpful. And what's fascinating to me is that for pretty much all of the great investors, they have their own version of that type of simplicity. So when I interviewed Jack Bogle, for example, 20-something years ago, the founder of Vanguard, he said to me, look, the idea of indexing is simplicity itself. He said, basically, when you have a middleman, a croupier, as he put it, scraping off money from the top every time you buy something, it eats away at your returns. And so he said, on average, actively managed funds, which have these high costs, these high expenses, these high transaction fees for their trading, higher tax bills, they have to underperform on average when compared to index funds, which are, where you might be paying 0.1% or 0.014% or whatever, some minuscule amount per year. And so he said it was the simplest observation that index funds had to win. And most people at the time totally dismissed the innovation of index funds. I mean, he at first, I think he raised something like $11 million for the first index fund. And people dismissed it as basically an exercise in mediocrity. How could you want to get the market return? It's so mediocre. And that observation of his, that lowering your expenses gives you a tremendous advantage, has led to Vanguard now managing more than $7 trillion. But it was based on the most simple observation. And whether you index or not, it's a really important observation, because what you need to understand for a regular investor is, let me keep my expenses down, because those expenses really work against you. They compound over time. And there was a wonderful example from Bogle where, if I remember the math, he said, if you invested $1 million and you made 10% a year over 30 years, sorry, I think it turned out to be something like $17.5 million. And if you took off 1.5 percentage points a year for your fees, you made $6 million less over those 30 years. So that 1.5% a year in expenses cut your ultimate winnings by $6 million over 30 years. And so it goes back to Tom Gaynor and his marginal improvement in his weight of losing £1 a year versus me putting on £1 a year. That's
I'm living my investment portfolio, man.
Exactly. It's those marginal differences become hugely important. And so that was an observation rooted in simplicity for Jack Bogle. Likewise, I think for Greenblatt, an observation rooted in simplicity. Let me buy things for less than they're worth. And so for all of us, I think it's really important to say, what do I believe? What are my principles? What's my investment approach actually based on? Why do I think it's going to work over time? And so I think it's really helpful to put down in writing what the simple principles are that you're using to guide you, partly because when things go haywire and you're living through a tumultuous period, you can look at your kind of operating manual, your rules of the game, and you can say, oh no, well, this is why I don't sell. This is why I don't panic, because I know that I don't want to be trading in and out of the market. I know that the market predictions are, as Bill Miller said to me last week, they're just futile. It's just futile to make market predictions. So just don't do it. Just position yourself to survive an uncertain future, but don't waste your time predicting whether the market's going up or down. And so just have that sense of what you truly believe in is very clarifying.
One of the chapters I really enjoyed was Nick and Zach and how they only invested in 3 shares, Costco, Amazon, and Berkshire Hathaway.
Yeah, they're extraordinary. And in a sense, when they were running a hedge fund, Nomad, they were a little more diversified. They owned about 10 stocks. But now, they have this extraordinary record. They beat the market, the MSCI International Index, the World Index. They beat by, I think, 804 percentage points over 13 years.
Wow.
And part of what they did is they just had this very concentrated portfolio of stocks that they understood incredibly well. And they were very, very patient owners of these stocks. And for the most part, they were all companies that were based around one business model. They basically figured out there's one business model that's better than all the rest. So again, it's a very good example of simplicity, where they said, well, if you look at a company like Costco, what they basically do is they have very, very low costs. They're very efficient. It's an incredibly well-run company. And so they would, so they would mark up their products by something like 14%. They never allowed themselves to mark up products by more than 14%. So if you're a regular supermarket, maybe it's 30% markup. So they're giving this incredible deal to their customers, which they can do because they're very efficient. And so then customers become more loyal and spend more and more. So the revenues go up. But then instead of pocketing those profits and saying, well, yeah, more gravy for us, they share those economies of scale with the customers to give them an even better deal. And so it's an act of deferred gratification in a sense. They keep giving a better and better deal to their customer. And so the customer keeps spending more and more money. And so what Nick and Zach realized is that this was the embodiment of what they call scale economies shared. So it's not just, yeah, you have scale economies, so you become richer and richer. It's you share the benefits of that scale. And the beauty of that is that instead of becoming kind of overburdened by your size, when they become very big, they get kind of slow and sluggish. But instead of that, because they use that scale to give better and better deals to their customers, their growth their size actually became an advantage. And so then when Nick and Zach saw Amazon come along, they were like, oh, it's Costco with speed, because it's Costco on speed, because they could basically say, well, look, here's a company that keeps deferring its own profits. And so Wall Street kept saying, well, how come they're not making money? It's unprofitable. But what Amazon was actually doing was saying, no, we have enormous revenues, and we're just sharing those cost benefits to give better and better deals to our customers to deliver stuff faster and faster, subsidizing that postage and stuff, so that it's just an incredible deal. And so basically Nick and Zach bought in at something like $30 a share. And so when I spoke to Zach recently, his personal portfolio is basically 70% in Amazon, because he's never sold a share of Amazon. And so really, again, it's this simple understanding that this business model is incredibly powerful, and then a willingness to say, well, as Nick said, everything else seems a little bit trite and stupid in comparison to this one business model. Once you realize that this one business model is better than all the rest, why wouldn't you bet big on it? And so he ended up with this 3-stock portfolio, personally, 9-figure 3-stock portfolio, because he's like, well, no, these companies, they have great destinations because they keep behaving really smartly, intelligently in a long-term way, in a world where everyone else is so dominated by short-term interests. Wall Street wants you to make money now. And here are companies like Berkshire, Amazon, and Costco. They're like, yeah, we'll make money in 5 years off this new product that we have. And so it's a very different culture that's much more long-term and much more focused on benefiting the customer. And so I think there's a kind of beautiful moral there for the rest of us, which is in a world that becomes extremely short-term, the more you can focus on the long term, the more actually you have a competitive advantage. And I think that goes for an Amazon, it goes for a Costco, but it actually goes for us as well.
Very learned, William. My goodness. Let's talk about Arnold van der Berg.
Yeah.
Wow. What a man. What a story.
Yeah.
Holocaust survivor. I dare anyone to read this chapter and not feel profoundly moved by it. You say there's no one in the investment world that you admire more. After hearing a little bit about your background and history, I can understand why you feel a connection to Arnold even more now. What did you learn from him?
Yeah, Arnold is very remarkable. For readers listeners who don't know about Arnold, he was born on the same street as Anne Frank in Amsterdam. And so he spent the first couple of years of his life in hiding. And at a certain point, his parents decided, well, if the Nazis come in and search our house, actually their friend's house, they were staying in a kind of fake area, like there was a fake wall in the back of a closet, and they would hide behind this closet. And they said, if the Nazis come in and search, and Arnold or his brother Sigmund make a noise, we'll basically all get taken to Auschwitz, and they would kill the children first, the women and children first. And so at a certain point, they decided, we need to try to get Sigmund and Arnold out. And so they contacted the Dutch underground, and this girl who was about 17 years old, who didn't know the family, basically put her own life and her entire family's life at risk by smuggling Arnold out to the countryside, to an orphanage in the countryside. And so Arnold starts his life in basically the worst possible way. His brother Sigmund is put on a farm with this other couple, the childless couple who raised him during the Holocaust. So he's separated from his brother, who he loved. He's separated from his parents. So for years, he thought that his parents had sent him away because his mother didn't want him. They didn't realize that it was because, they were trying to save his life. And by the age of about 6, basically, because he was living in this orphanage where there was almost no food, he couldn't really walk. He was just sort of shuffling along on his knees. And when his parents did go to Auschwitz, but actually survived miraculously. And when they came to pick him up at the age of 6, he didn't recognize them. And he said, I didn't even care. I would have gone with anyone. I just wanted to get out of that place. And his father was literally scared to pick him up because he was just skin and bones. And Arnold said to me, if I'd been there another 6 months, I would have died. And so he started in the worst possible way. And when he moved to Los Angeles, to a very rough area of Los Angeles, and was beaten up on his first day of school because his mother dressed him in lederhosen and long socks. And so, you can imagine this poor guy. I laughed when he told me this, and then felt really guilty. But this image of this poor boy being sent to this really tough school in East Los Angeles wearing lederhosen. It was kind of lederhosen, like it's like you were in The Sound of Music, like being dressed in The Sound of Music while going to the hood. And so, so he had a terrible time at high school, barely made it through high school, never went to college. And one day heard his mother talking to a psychologist And they were basically worried about why he was doing so badly at school. And the psychologist said, well, maybe he has brain damage from being so malnourished as a child during the Holocaust. So he grew up with this idea that he was incredibly stupid. He was a tough kid. He was always in fights. And so part of why I'm so fascinated by Arnold is that having been dealt the worst possible hand, he transformed himself into this incredibly successful investor and businessman running this very successful firm, but also into this incredibly successful human being. And so as I write at some length, after the Holocaust, he was full of rage, and his first wife left him, and he was full of rage at her, and he was full of rage at his parents. I mean, his father used to beat him up as well until, finally at a certain point, Arnold punched him back. And I remember Arnold saying to me, his father was sort of sitting in their living room with his head in his hands, just kind of crying. It was like, I can't believe my own son would hit me. And he's like, not only did I hit you, but next time I'm going to hit you first. And so there's this, he had to be tough to survive. And so, full of rage, full of anger, no self-confidence at all. And then started to take control over his inner landscape and transform himself internally. Became obsessed, curiously, with self-hypnosis and started to rewire his brain, started to rewire the way he spoke to himself. So he would say to himself over and over again, for example, I'm a loving person. And so over time, he actually transformed himself. He transformed the way he thought. And as he did that, he also really transformed his life and became incredibly successful. And one of the people who really helped him to become incredibly successful was a psychiatrist called Dr. Rameljak, who he talked to about that girl who saved his life, the 17-year-old. And he said to him, I don't understand. Why would she risk her life? This has tormented him for years. He's like, I don't understand why she would risk her life and why her father would have allowed her to risk her life to save a total stranger. And his therapist said, well, it's simple. And he's like, it is. Tell me why. And he said, well, for some people, their life is more important than their principles. And for other people, their principles are more important than their life. And so Arnold said, I need to operate in a way that's worthy of the people who saved my life. And so I need to have a principle-driven life. And so he became this very ethical, very decent, very, very philanthropic, very loving, very kind bloke. And so for me, there's something kind of triumphant about this as a story of personal transformation. And so, I tell the reader a little bit about how he became a successful investor, but what I'm really interested in is how he became such a successful human being. And part of the reason for that is that I'm trying to say, well, look, when you study the great investors, you see actually that none of them had a straight upward trajectory. They all had difficulties. They all had times in their life where they went through the ringer. And when you see someone like Arnold turn everything around, having been dealt the worst possible hand, you think, well, yeah, maybe I can do it too. Like maybe actually when I'm sort of depressed and melancholy, or I feel kind of listless, or I feel like I've failed at something, or I'm going in the wrong direction, like, well, I still got a better hand than Arnold. I mean, so maybe I should focus on my inner landscape. Maybe I should focus on changing the way I think, on the way I talk to myself, on sharing more with other people. And that was one of the things I was very inspired by with Arnold, is I would see the incredible joy that he took in helping other people. I mean, Arnold, as I mentioned before, he's the one who hypnotized me to change the way I spoke to myself. And multiple times since writing the book, he's called me to see how I'm doing, to see if he can help in different ways. We're constantly sending each other books. And you see the way that his kindness and his desire to share has infused his life with these very warm, loving relationships. And so he has this son, for example, who's the president of his company. And you just see the love that the father and the son have for each other. And so I see stuff like that. I see the warmth of the relationships. I've spoken to Arnold's wife as well, Eileen, who's extraordinary. And, they're about to celebrate their 50th anniversary. And
Mm.
there's just something really moving about it. And so when I look at them, I think that's a successful life. And it changes my view of what a successful and abundant life is. And so I'm trying to say to people in the book, here's how you become rich. Here's how you become financially secure. But don't lose sight of what actually constitutes a truly successful and abundant life. And when you look at Arnold, it gives you a sense of what that is. And so that's why I write about him in the epilogue. And that's why he's the person I end the book with, because I want to, money is important. I mean, when we talked at the start, and I was talking about my childhood fantasies of making money gambling and becoming rich and independent and not having to work for people I didn't like, I still believe that. I still think it's really important to be financially independent, secure, not to have to worry about paying your bills. I don't diminish the importance of money, but if you're rational about these things, if you're sensible about it and you're thoughtful about it, you have to see that relationships matter more, and that any abundant life actually has to have deeply fulfilling relationships. It has to have some degree of sharing. And you see that with people like Arnold. You see that the reason he's so joyful is partly because he loves what he does and he enjoys his work and he's found something he's good at, but he's just got great relationships with people that he loves, high quality people surrounding him who want to be with someone who's a very high quality individual. And he's constantly looking to share and help. And so this is one of the great paradoxical secrets of life, right? It's when you're so focused on yourself, on your own needs, there's something kind of stunted about it. It's not a joyful way to live. And when you start to focus on lifting up other people, paradoxically, you end up becoming more joyful yourself. And so when I see someone like Arnold, it makes me think, oh yeah, I need to focus more on building good relationships and on sharing more and trying to be kinder and trying to be more loving and more sharing. And that can sound kind of hokey and pious and self-righteous, but I think what I like is the fact that when you see these great investors, they're so brutally pragmatic. And so they're just really rational people who are like, well, this makes for a happy life and this makes for an unhappy life. So what am I going to choose? And so for me, that's what I'm kind of trying to lay out for people is this is intelligent behavior that you're seeing from people like Arnold.
I think, look, the last two questions I have, you've answered. I don't think I need to ask you any more final words about the book.
I guess one thing I would say is it's a little bit of a buffet. There are a lot of different ideas in there that I think are quite powerful, not because I'm such a wise and evolved human being, but because I'm getting to interview people who are very wise, very smart, very thoughtful. And what I would say is, when you find an idea in the book that resonates with you, go big on it. Because when I see the success of people like Charlie Munger, Monish Pabrai, it all goes back to something that Munger said, which is take a simple idea, take a good idea, and take it seriously. And so when you find something in the book that you're like, wow, this guy, Tom Kane, figured out something really interesting about the compounding of good habits, or Monish Pabrai figured out something really important about the benefits of being truthful, or the benefits of what he calls cloning, where he's basically taking the smartest people on earth and he's looking at what they figured out already instead of trying to reinvent the wheel. And so he's just shamelessly cloning all of these good ideas that he's figured out from other people. So when you find these good ideas like cloning or being more truthful or compounding good habits, go big on it, because it's to some degree it's the fanaticism of these great investors that makes them so extraordinary. It's when they find something good, they don't just dip their toes in the water and say, oh yeah, that's a nice idea, and then move on. And so I think that's how I would encourage people to read the book. It's not about finishing the book and having this general sense of like, oh yeah, I should be more rational. It's find a few things that you're like, no, I'm going to internalize this. I'm going to actually act on this, because you don't need to act on all of these things, but they're such powerful ideas that have time tested by these extraordinarily successful people. And so just take a few things and make them really a part of your life. And these things have helped me a great deal. So I'm sort of a guinea pig for these ideas. So I can tell you they're helpful.
Ian Green, your dulcet tones from Eton and Oxford just made that hour go so quickly. Thank you so much for your wisdom.
Thank you. It's lovely to spend this time with you. I really appreciate it. It's been a great pleasure.